Silver is down 40% from its all-time high. Gold is down 16.5% from its record. Both moves happened in under 8 weeks, and this Friday, right now, you are heading into a weekend with the lowest futures liquidity of 2026 and an active shooting war in the Middle East. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Now, two forces have collided simultaneously in the gold and silver market. That collision is what created this gap risk. Let's get straight into it. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today, the Federal Reserve and the Iran conflict happening at the same time. Gold at 4,780, down 16.5% from the January 28th all-time high of 5,602. Silver at 72.40, down 39.5% from the January 29th peak of 121.67. Fed policy rate held at 3.50 to 3.75%. Dot plot updated to signal 0 to 1 cut for the remainder of 2026. That reverses prior guidance of 3 cuts, effective the moment the statement dropped. This follows a producer price index print of plus 0.7% month over month, more than double the 0.3% consensus, with the year-over-year rate accelerating to 3.4%. The unusual detail is not the hold, it is the simultaneous compression of two separate forces into the same 48-hour window, a hawkish Fed reversal, a hot inflation print, an Iran war driving oil above $100 per barrel, all of it landing together. The timing is what deserves scrutiny, not any one variable. The timing. Think about what that sequence actually means. When two macro forces align against the same asset class at the same time, the move is not additive, it is exponential. The ones paying attention already know what to watch when Asian markets reopen Sunday evening. Before I show you the full data picture, consider this. The last time COMEX gold futures volume dropped 25% in a single month while open geopolitical risk was elevated. Gold subsequently moved more than 15% within 60 days. That move was not predictable in direction. It was predictable in magnitude. The data is already telling you something. Let's build it out. Now let's build the full picture because the Fed decision and the Iran conflict do not exist in a vacuum. The U.S. Bureau of Labor Statistics PPI report, plus 0.7% month over month for February 2026. Confirmed inflation remains embedded above consensus expectations. The U.S. Treasury Department shows the 10-year yield at 4.28%, near its highest level since August, raising the real cost of holding non-yielding gold and silver. The ICE U.S. dollar index sits at 106 PIR, a mechanical ceiling for dollar-denominated commodity prices. CME Group COMEX data confirms gold futures volume down 25% from pre-war averages. Silver futures and options volume on the CME is down 60% from early 2026 levels. The SPDR Gold Trust, reported in its daily holdings disclosure, has shrunk to its smallest size in 9 weeks. ETF outflows from leveraged silver instruments have been severe across the board. The rate of institutional de-risking is not slowing, it is accelerating into the weekend. The data is doing the talking. The ones who warned that thin liquidity plus geopolitical risk plus a hawkish Fed was a dangerous combination, they are not saying much right now, and here's what makes that picture even harder to ignore. COMEX registered silver at approximately 103 million ounces, backs open interest representing 429 million ounces of paper claims, a 24% coverage ratio confirmed by CME Group warehouse reports. At the same time, institutional positioning in both gold and silver has moved defensively short or flat. That is not a contradiction. That is the gap risk setup. Defensive short positioning into a weekend with binary geopolitical outcomes means any positive surprise generates an asymmetric short covering rally, and any negative surprise accelerates an already thin market sell-off. Setups can take a long time to resolve. What this tells you is the structural picture. The timing is a completely separate question. Anyone who claims to know the timing is selling something. Here is the number most people are not focused on right now. Friday close. Asian reopen. Sunday evening U.S. time. That is approximately 40 hours with zero futures market liquidity to absorb any weekend development. The Iran conflict, now involving active U.S.-Israeli military operations, has pushed oil above $100 per barrel and introduced a Strait of Hormuz supply risk that covers 21 million barrels per day, approximately 20% of global oil supply through one choke point. If the Strait of Hormuz becomes contested over this weekend, energy prices gap, inflation expectations gap, the Fed is further trapped. Gold reprices higher on safe haven demand. Silver reprices lower initially on industrial demand fears, then follows gold higher as monetary demand dominates. If a ceasefire signal emerges, oil retreats, dollar softens, Fed narrative shifts, and metals rally 5 to 10% before London opens Monday. Markets are still pricing a contained conflict scenario. Look at gold at $4,680 and silver at $72, and tell me what probability the market actually puts on clean resolution before Monday. When markets start pricing the reality of what sustained $100 plus oil actually means for a stagflationary Fed in an election-adjacent political environment, gold reprices higher, silver follows. That is the historical pattern. Every time this combination of variables has appeared together, it has not been different yet. Gold Western Spot at $4,780. Shanghai Gold Exchange physical gold carries a $40 to $70 premium in USD terms. Silver COMEX paper at $72.40. Shanghai Gold Exchange physical silver at $78 to $80, an $8 premium above Western paper price. The binary short-term picture is this. If the Iran conflict escalates this weekend, oil spikes past $110, the DXY breaks 108, and gold gaps to $4,400 at Monday open. Silver tests $68. If ceasefire signals emerge, oil retreats toward $90, dollar softens, and gold gaps to $4,900 to $5,000. Silver follows with a 5 to 8% move. That is the only short-term read that matters right now. As for trading it, I cannot see a clean picture on the lower time frames right now. I cannot tell you what gold does when Asian markets open Sunday. Nobody can. If you think you know, good for you. This is a 40-hour liquidity vacuum with active military conflict and a Fed that just broke market consensus in a single statement. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. The DXY at 106 mechanically suppresses all dollar-denominated commodity prices, confirmed by ICE data. The 10-year Treasury yield at 4.28% confirmed by the U.S. Treasury Department raises the real cost of holding non-yielding metals. Silver futures and options volume is down 60% from early 2026 CME Group averages, meaning thin markets amplify downside moves disproportionately. The bull case is equally real. Shanghai physical silver at $78 to $80 trades 8 to 12% above COMEX paper, confirmed by Shanghai Gold Exchange data, signaling physical demand that paper selling cannot erase. COMEX registered silver of 103 million ounces backs 429 million ounces of open interest, a 24% coverage ratio confirmed by CME Group warehouse reports that cannot remain stable indefinitely under delivery pressure. Institutional positioning is defensively short or flat, confirmed by SPDR Gold Trust holdings at a 9-week low, meaning a positive catalyst triggers asymmetric short covering, not orderly buying. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Everything shown today points to one unavoidable fact. This is not a normal Friday close. It is a binary weekend with 40 hours of zero liquidity, active military conflict, a trapped Fed, and a gold and silver market sitting at technically significant levels with institutional positioning defensively positioned in both directions. The ones who verify don't argue about it. Don't take my word for it. Verify every number I gave you today. Check the data yourself. CME Group warehouse and futures data at cmegroup.com. U.S. Treasury yield data at fiscaldata.treasury.gov. U.S. Bureau of Labor Statistics PPI data at bls.gov. Logic over hype. Always, if this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. OG John AG 1.0, out.